21,900 yesterday, and the start is likely to be in the green. The Nifty's opened above 22,000. It's straight away off the bat, a gain of close to about 90 points. Sensex is higher by nearly 300 points. Mid-caps are moving in step with the frontliners. The mid-cap index is up close to about 0.5%, hovering around 22,000, give or take a couple of points. On the gaining side, you've got oil marketing companies. BPCL, which got an upgrade today, is the top gainer. M&M continues to see buying. Yesterday, it rallied 7%, despite Q3 numbers being in line. Analysts are bullish about the UV volumes for M&M and M&M. The buying continues. Tata Motors is giving it company on the way up in the auto pack. You've got Infosys, Wipro also higher in trade. ICICI Bank is seeing some green at the start of trade, and HDFC Bank continues with its gains from yesterday, and HDFC Bank has clocked in a 0.5% open. On the losing side, ONGC is your top loser. That's down nearly about 2%. Axis Bank continues to see correction from yesterday. So Axis Bank is down nearly 0.5%. UPL, where there was that Fitch downgrade on its rating, UPL is a bit subdued in trade. But all in all, it's a pretty good start to the week. The Nifty is holding on to a 100-point gain now. 22,000
on the Nifty. That's the big headline this morning. So the bulls, they're driving home the advantage. A couple of sessions ago, we went down to around 21,530 when the US market sold off. And from there, you've seen a 450-point rally. Stocks in focus today. Gujarat Gas, that's down close to around 5%. We're telling you that brokerages not too optimistic post the past quarter's numbers, and that's why they're remaining a little bit skeptical on the prospects going ahead. They're losing market share as well, and at around 30 times, well, the stock is not very, very cheap. So that explains why that stock is down. Torrent Power as well, down close to around 1.5%. What's doing well? Glenmark Pharma is up close to around 5%. I think the con call details were fairly impressive, so that's why that stock is bucking the trend. You have NBCC is up close to 4.5%. Remember, we have the management that joined us, just yesterday, and they are talking about doing revenues of around 13,000 crores in the next fiscal, and in the next 5 years, they're talking about 25,000 crores of revenues with PAT of around 1,250. So explains why that stock as well is moving in early trade. A couple of other notable movers. Polycab. Yesterday, the stock ended at the high point of the day. Today, that one, in fact, is spiking up as well. It's up close to around 2%, so good move out there. Torrent Power is down close to around 2%. So it's a good-looking screen, one would say. You have close to around 6 stocks that are advancing for every 1 stock that's declining. So it's a fabulous-looking screen. I think MRPL, after the big run we have seen, finally giving back some part of it, down 4%.
Absolutely. Overall, though, it's a near triple-digit gain, right? 100 points, 22,008 is where we have opened at in terms of the gains. Now, just a few other names which should come up on your screen. Irida is up 4%. It's a top volume sort of led gainer. We were just talking about oil marketing companies with Harsh. It's BPCL comes up with a 4% pop, 677. And I think we had Nimesh highlighting that Jeffries note as well.
The target price is 890. What Jeffries has put on BPCL, 890. And they say amongst the oil marketing companies, this one offers the largest margin of safety.
Yeah, absolutely. But, the thing which caught my eye is not the price target, but where they're coming from. I think it's
underperform.
No, I think the last price target was under 500.
Okay.
So they're jumping from 500 to...
And it's a double upgrade, right? Yeah. Underperform straight away to a buy.
Yeah. All right. Well, Bank of India is up 3.5%, 147, 148. Large volumes, third or fourth largest volume traded gainer. Rain Industries, I think we mentioned, 6.5% higher. It's a big volume-led pop on Rain Industries. AG's is up 6.5%. It was a big mover yesterday as well. I think we mentioned names like Dilip, Buildcon, etc. Glenmark is coming up with a 4.5% gain. So that's a large one, 848 on Glenmark. There is Bharat Dynamics, which is up 3%. Data Patterns, there was, Nimesh was highlighting that perhaps there's going to be a block. 8% higher on Data Patterns, almost $2,000 coming through on that one. There is HPL Electric. It's been a fabulous week for HPL Electric. It's up 20% this week. Of course, 8% today. Inox Wind and Inox India both were up 10% yesterday. Inox Wind is coming up with another 4% this morning. And Jyoti CNC, we had the management with us yesterday, 4% again. Again, it's a big week for Jyoti CNC, which has done phenomenally well. There is EPAC, which is up about 7% as well this morning. BL Kashyap, there was that order, started about 8% higher. It's cooled off. It's got about 4% right now at this point in time. On the downside, nothing. Gujarat Gas, Nigel highlighted. MRPL, we've highlighted. But big volume-led large price decline, not really. I mean, there's 1.5%, 2% kind of cuts, and we can talk about that as we go on. Paytm is down about 1.75% at this stage. We're at about 319 on that one. Amish Shah is head of India research at Bank of America Securities. He's with us here on the program to take some questions. Amish, good morning. Great to see you back on the channel. Appreciate your time. Prashant this side. So we've been sort of treading water just under earlier highs. No real meaningful shake-off or correction at all. There was a fortnight short-lived correction in January, and then maybe this mid-cap one-day kind of sell-off that we saw earlier. But beyond that, not very much. How are things looking, Amish? Is it up and away? Because now we are heading closer to the general elections as well. And recent opinion polls, etc., show that Prime Minister Modi and the BJP and the NDA alliance is in pretty top shape.
Sure. Good morning, Prashant. Thanks for having me. Look, if I were to talk for the year as a whole, we do think that Nifty will continue to do well. As you know, our target for the whole year for Nifty is around 23,000. In the base case, we do think that in the best case, it could even go to 24,500. So there is upside. In the near term, I think markets may consolidate because there is rising risk of accelerating inflation in the US. That pushes out the view on the Fed rate cuts that one had earlier. And a relatively muted third quarter earnings, I would argue.
Amish, morning. Rima here. Today, the BofA research team has put out a note on PSU banks where you've upgraded State Bank of India and Bank of India. You go on to say that, the valuations are converging to just 1 to price to book, pricing in a cyclical improvement, and there's room for FI positioning in PSU banks to go up. So tell us, when you try and talk to the FIs about PSU banks, and hitherto they've stayed away from most of the PSUs at large, what is now the opinion amongst the FIs, and how much could they go out and buy, and can it be at the expense of private sector banks?
It looks like, because first of all, there was a massive ROE differential between the private banks and the PSU banks. And as a result, there was a massive valuation differential between the two as well. But as the ROE differential is now shrinking, the view is that PSU banks' valuation should start expanding and converging to some extent with the private sector banks. And operationally as well, as we all know, PSU banks and PSU PAC in general has been improving on an operational front, so that deserves, this rally to continue. So specifically on the PSU banks, we think OPEX now is going to, OPEX run rate is not going to grow as fast. They do have a pretty strong liability franchise. They will probably be able to gain a reasonable market share from CASA. Valuations, as I said, are relatively still at a discount to private sector banks. And as a result, we think that rally can continue.
Okay, all right. Hi, Amish. Good morning, and good to see you in as always. What are you making of these other, the clutch of stocks that are doing very, very well? The OMCs, the oil and gas stocks. Someone would say that re-rating is taking place. The way those stocks have moved is a bazooka move. What's your view on them from here on?
Yes, Nigel, we are not in general positive on the PSU rally as a whole. We think that, one should look at it more on a bottom-up basis. So the power, steel, and the energy pack of the PSU rally is something that we are not comfortable with. You mentioned the energy stocks within that. But at the same time, we do think that the PSU banks, some stocks on a bottom-up basis linked to defense or railways, that those are the pockets of opportunities within PSUs that we are more excited about.
Yeah, no, absolutely. Got that. Amish, just a quick word on, many have said this, and I'm sure you've heard it from investors on the buy side, etc. as well, that the real bull market and the way to capture the growth story, the infrastructure spend, the capex spend, is via smaller companies, not the big giant conglomerates, etc. To that end, Amish, from in your coverage universe, and what are the best sort of plays there? What kind of companies? What kind of names? I'm talking about the slightly longer term here.
So Prashant, see, look, first of all, as we've discussed in the past, clearly capex cycle is going to be, here for long. We've been arguing for 10 years of capex upcycle. We are currently only in the third year of it. So from a long-term perspective, there is genuinely, earnings upside or ROE multiple expansion. So these sectors are typical deep cyclical sectors, and as a result, the delta that you see in terms of growth is meaningful. In terms of how should we evaluate as stocks, I think we have created 4 baskets. So we are calling them as product companies, companies that do EPC contracts, so project companies, the asset owners, and the indirect beneficiaries in terms of whether it is loan growth for banks or it's steel or cement demand for those sectors. So that's a pretty wide spectrum on how we can play that. You are right that the delta of growth will be higher for the mid cap and the small cap companies. Not all of them we are bullish anymore, given the kind of valuation expansion that we've seen in that sector. But I would argue that even the large cap EPC companies or even the cement companies or even some of the banks which are more wholesale focused, even they are not as expensive if you're really trying to play this from a long-term perspective. So it's a pretty wide spectrum, and I would argue that several sectors and stocks will benefit on the back of the capex-led upcycle that we're talking about.
So you like large cap EPC, some of the cement names, some PSU banks. What else, Amish? What else do you like? And you also said that, some of the mid caps now are unattractive because of the valuations. It's also important to know what to avoid. So tell us, what is it that you don't like now?
So, again, as I said that, I unfortunately, because I can't talk stocks, but, generalizing it, while the thematic in defense and railways, for instance, is for real, we think that, in the here and now, valuations have clearly gone much ahead of expectations. So they are pricing in like 3, 4, 5 years of growth already. And while I'm a believer in the capex cycle, execution is a different ball game altogether, and one will have to, execution is not always perfect. So I think the stocks are not discounting for that as of now. So let's say as an example, some of the automation companies, if I were to assume that the cycle goes on till 2030, and if I were to throw in the best case working capital estimates, the best case margins, the best case order flow growth that they can get, and then assume that 2030 is the end of the cycle, so their valuation comes back to the normalized levels versus the peak valuations or peak cycle valuations. We are basically saying that from here until 2030, these stocks now have only a 50% upside left. So 50% upside over a 7-year period is around 7% CAGR returns, which is something that you can generate out of a government bond, which is very safe. So is the risk reward now worth it? Is the debate. And then as a result, I think what the markets are basically doing is that they are trying to get that entire 50%, which is due in the next 7 years upfront, and which is the worry that I'm talking about. That yes, that upside is justified, but it is too soon that we are seeing in these stocks, which is the discomfort that we have.
So that's broadly on railways and defense. Are there any other sectors or themes or pockets where markets have front-loaded all the gains, and there is that execution risk?
Yeah, I think the power generation, power transmission, companies as well. I would probably put in a few of the automation stocks within that as well. We've been downgrading a lot of stocks within the mid and small cap, coverage within the capex theme, despite being so bullish on the capex cycle overall.
Okay, all right. Amish, China's been in disarray, so to call it, and data points are not, looking good from there. But I think some part of the street is a little bit optimistic that maybe they have hit a trough and things will improve from here on. If that's the case, then metal demand will improve. And that's why, even though there are risks to Q4 numbers for some of these metal stocks, but most of them have seen a big surge. How are y'all playing this entire metals theme? Do you all believe there's scope to move up? And if yes, what do you like, ferrous and non-ferrous?
So Nigel, unfortunately, we are yet not a believer of the big pickup in the economic recovery of China. So in fact, as we know, one third of the Chinese steel demand is from China real estate, which is not something that we think will improve in a hurry. And as a result, steel as a basket is not generally what we are positive on. The non-ferrous is relatively what we prefer at this point.
Lovely. All right, Amish, thanks so much for joining in and filling us in with all of those details. Wishing you a good Friday ahead and look forward to having a chat with you rather soon.
Same to you.
Let's focus on JK Cement. That's the next corporate on our show. The Q3 numbers look very, very good. Sales volumes as well did surge up. And they've also announced capacity expansion. Mr. Anuj Khandelwal, the business head, joins us on the show. Hi, Anuj. Good morning. Thanks so much for joining in. Well, tell us, how is demand on ground? If you could tell us ahead of the election, how do you normally see? Do you see things slow down a little bit? Is construction activity as good as expected? And what does that mean in volume targets for this year as well as next year?
Hi, Nigel. Firstly, thanks for having me on this segment. And yes, look, the demand for the full year per se till now has been really great for the industry, right? The overall industry has grown at double digits. But in Q4, we are seeing slight slowdown from the lofty levels we've seen earlier this year. So we'll still, expect the industry to grow around 5% or so in Q4. Q3 was also in the similar levels. What we believe is maybe in the second part of the next financial year, we'll again see huge growth coming back after the electoral activities have concluded. But overall, still, I would say from an overall year perspective, it's quite a fantastic year from a cement demand outlook.
Okay, all right. And for this year, the volumes that you are targeting, I think grey cement was around 16.5 million tons. And overall cement, you were looking at around 18.5 million tons. Is that a fair estimate?
Yes, that's right. So on grey cement perspective, we are targeting around, let's say, near 16.5 million tons as we had guided. And overall, on a consolidated volumes basis, we'll end up somewhere around 18.5 to 19 million, which will still be, let's say, a good 16-17% growth versus the previous financial year.
The problem is the challenge is on a high base, how much can you grow? So if you're expecting the second half of the year to look good, then what kind of a growth can you expect on this high base? Point number one on volumes. And the EBITDA per ton, what is the outlook on that front as well from year on? I recall when you joined us last in November, you were saying the second half of the year will be much better. And your past quarter actually was very good. So what is the rough range we should work with?
Okay, so let me first take up your point on the volumes. Yes, of course, we have had good volume growths over the last 3 to 4 years, but we are confident of a good volume growth in FY24, FY25 also, which is the next financial year, because we have also new capacities coming up in Prayagraj, and the capacity which has just got commissioned, Ujjain, will also, give us more volume leverage. So overall, we still believe that, maybe we'll be able to clock a healthy volume growth next year in spite of a relatively slow start to the market in the first half of the next year. So maybe around 8 to 10% growth, we'll definitely, try to target. As far as volume, as far as EBITDA goes, yes, last quarter was really good. Overall, look, we had a target of 1,000 rupee per ton on a consolidated basis for this year. On a YTD basis, we are running at 1,080 rupee per ton or so. So we are, targeting to end the full financial year FY24 around that levels, 1,080 to 1,090 rupee per ton, which will still be a good 90 to 100 rupee per ton greater than what we had internally targeted.
Okay, that's good to know on the EBITDA per ton. What about, the volumes on the premium sales? What would that number stand at for this year and even for next year as you look to target an 8-10% kind of a volume growth?
Yeah, so premium sales, as I had covered in the last segment also, we are right now at 12% of sales. That's how our premium sales is. We are taking very conscious steps on, how to increase premium product. Next year, we'll be targeting to touch 14-15% on premium sales.
Also, since we're on the topic of, volume growth, I want to touch upon your capex plans. You've laid out a strategy to hit 30 million tons, I think by 2030. Will you look at an acquisition in the... You want to hit 30 million tons by 2030, right? That's your capex plan.
That's not right. Look, we are at 22.2 million right now, with 2 more million tons in Prayagraj coming up by July. So it'll be 24 million by June 24, and by March 2026 we'll touch 30 million. Because with the expansions which have been approved by the board, and assuming the construction time which will take to make those expansions live, we'll touch 30 million by March 26.
By March 26. And so there is no acquisition plan for the next 2 to 3 years.
So look, our base plans are always organic growth, because you really can't plan for an inorganic opportunity. They come when they come. However, if there are some opportunistic, if there are some opportunities which come by our way, we continuously do evaluate. But our base plans are always through organic growth.
I know the couple of plans that are on the block, Anuj, which I can't, name them. And I think y'all as well, being a large player, would be aware of them. Couple of big players on the West Coast. In the South, there are quite a couple of players as well that could be looking at selling out. If you'll have to go for inorganic growth, let's just assume that, hypothetically, what would you all be willing to pay for that?
It's a very, I would say, hypothetical question. It's a lot of conjectures are there, so I would not hazard a guess. But yes, look, opportunities, valuation of an opportunity depends on a lot of things, existing capacities, the potential to expand, etc. So it's very difficult to put a dollar per ton number to an opportunity. But as I said, we firmly believe our base growth plans are organic growth. So inorganic growths are, once if some opportunity comes up, we'll have a look, but that's not what our main focus is.
Interesting. You're setting up capacity at $60, $70, $60, $65 per ton.
Exactly.
That's why I just thought that if you have to go and pay, I don't know whether you'll be willing to pay more than that.
No, look, conceptually speaking, inorganic growth opportunities gives you faster time to market as well. So,
yes,
of course, there's a bit of premium to that. But, you are absolutely right that our greenfield or brownfield expansions happen at a much lesser rate, the rates which you kind of mentioned. And we have a good track record of evacuating the capacity fast. So we believe in our ability to evacuate the opportunities fast, and hence shrink the time to market which takes place when you go for an organic opportunity.
Got it. Anuj, let's add some color to this interview then. The paint segment, that's a very small part of your business, but you're optimistic on the prospects. I think for this year so far, you've done around 120 crores and it's still loss-making. By FY25, say towards the second half, do you see this business turn around? Point number one, will it be profitable? And second part is, on the top line, what kind of a number can we look at? I assume this year you end at around 150 crores or maybe a little bit more than that. What do you end next year with?
So Nigel, I don't look at the paints business per se, but maybe I can still throw color, as you said. This year has been a fantastic start. As you said, we've crossed triple-digit mark, and more importantly, there is a good acceptance from the channel and customers in the geographies which we sell. I won't say that we'll in a way turn around the business, because the business is so nascent that it's the losses which you in a way mentioned are some startup costs. It's not essentially that the operations are not doing well. It's just the amount of investment which you need when you start a business. So, but maybe in maybe 18 to 24 months we'll start getting to EBITDA positive there. But more importantly, right now we want to grow the business, because the business right now, it's just started. We've made first few strides there. So our main focus is to first grow the business and then look at profitability there. But I would still want to say that we've committed in a way an investment number, including loss funding, to the board and the investors. We are sticking with that. We are very disciplined about it.
Okay, but right now the focus is on growth and not profitability. That can be on hold for the next 18 to 20 months. Just one final question, since we spoke about capex. What would your peak debt number be Are you looking to raise some more debt? And how will you fund that capex? Is there any, fundraise on the horizon?
Oh yes, it is because look, we are doing with the approvals for 6 million ton expansion, which came up in the later part of January, which is last month. We will spend around 2,800 to 2,850 crores on the expansion. So out of which somewhere around 1,000 odd crores will come from internal accruals and 1,850 crores will come from debt over a 2-year period. The way we look at it is that we want to maintain a healthy net debt to EBITDA ratio, which is around 2, because that balances the need for growth while keeping the financial discipline in place. As of December, the net debt to EBITDA ratio for our company is 1.64. So we are well within the thresholds which we've kind of kept for ourselves, and we are at a comfortable level. So that ratio we would want to keep it below 2 even when we take up this debt.
All right, we'll leave it there. Thank you very much for joining us, and it's a pleasure having you with us here, sir, on CNBC-TV18. Appreciate it. Well, that is J.K. Simen with commentary on the business. We'll, look at the market, which is up 100 points. So 22,011 is where we're at. We'll take a break. We're back with the management of Finolex Industries. We talk about the third quarter performance. A little later after that, we'll also have the management of Zen Technologies to talk about their earnings. Stay tuned. Back, the market's up pretty solid. 100 points on the Nifty is what we have. But as promised, we have the next management waiting by. Finolex Industries reported numbers. And third quarter was weak. I mean, revenues were lower and volumes were kind of subdued as well. So let's understand what has happened. Mr. Ajit Venkatraman is Managing Director at Finolex Industries. He's joining us right now to take some questions. Ajit, good morning. Great to have you with us here on CNBC-TV18. Prashant this side. So can we start there? I mean, was it start with volumes, basically? Is it lower offtake from a particular segment? Is it higher competitive intensity? What happened?
So towards the end of the second quarter, we started seeing slowdown of volumes, especially from the agri segment. And that was essentially driven by the negative sentiments for PVC prices. So that continued well into the third quarter, and that resulted in a drop in volumes in the third quarter. Whereas in the non-agri segment, we did do a fairly decent growth of over 15%.
And in agri, how is the fourth quarter panning out now? Has it picked up or is it still? Yeah.
Once the PVC prices stabilized around mid-December, the volumes have started picking up. And so far, it has been normal in the fourth quarter.
So for the full year, could you talk to us about what kind of volumes you will do?
So we are looking at anywhere between around 10% growth in the total overall volume.
FY24 volumes over 23.
FY24.
Okay, and because we're also getting into the election season, etc. So does that have any implication one way or the other?
So far, it has been holding on. And we need to see how the month of March goes, which is much closer to the election year. So at this point of time, the volume seems to be normal as predicted, but we have to wait and see for the month of March.
Okay. That's on the volume front. Agri volumes are weak, but for the full year, given the strength in the other segments, you're still likely to clock a double-digit volume growth. What about on pricing? PVC prices have also been a bit volatile, under pressure. What happened in Q3 and what's the outlook on pricing?
See, since I think mid-September onwards, we had negative sentiments on the PVC prices itself. So we did see some amount of correction, and the prices have more or less stabilized around $780, $790 per metric ton for PVC. And that seems to have stabilized, and it continues as of today. So any stability in the PVC prices helps the market to cool down and also have confidence in pulling inventory into the network. So that is what we are seeing at the moment.
All right, hi sir. Good morning, Nigel on this side. A couple of quick details then. What is your current capacity, if you could tell us, in terms of pipes and fittings? What is your total capacity?
The total capacity is around 470,000 metric tons, both pipes and fittings put together.
And what is your utilization as of now?
So utilization is anywhere between 60 and 65%.
Got it. All right. I wanted to ask you whether some of your peers are growing at a faster clip as you are. That's what it appears so. Could you tell us whether or not you're losing market share? I'm just looking at a Supreme Industries, their numbers. It appears they're growing faster. Can you clarify on that? Are you losing market share?
So we have two segments. One is the agri segment and the non-agri segment. Good percentage of our sales comes from the agri segment, which has been a little bit slow in the third quarter, whereas the non-agri segment has been growing quite well. The mix, it all depends upon the mix. Our mix has resulted in the growth rate what we have seen.
Okay, so in both the two segments, if I split it up for you, what is your current mix, sir? Agri and non-agri?
About 65-35.
65-35. How do you see this mix changing going ahead? And in both these two segments, are you holding on to your market share as per your calculations?
See, we have been growing faster in the non-agri segment than the market. Agri segment is a little bit less predictable because it depends upon a whole lot of other factors as well. And therefore, and non-agri segment is mainly driven by the building construction industry. And therefore, we have been tracking that fairly well. Agri segment is influenced by rainfall, PVC prices, because that segment is price sensitive. And therefore, it has been less predictive. In terms of the movement, we would like to, the reason our focus is on improving the non-agri segment is to bring more stability to our performance.
And what's the contribution of agri and to your overall volumes?
So it's a 65-35 split.
Within that, are fittings doing better?
See, fittings is, as non-agri segment grows, the fitting performance grows because there are more fittings needed for the non-agri segment.
Okay. So without getting into very specifics, could you tell us as we look into the next year, FY25, would the growth in non-agri continue to remain significantly ahead of agri?
We expect because the building construction industry is expected to grow at about 15%, 13 to 15%. And the CAGR expected for the next 5 years is that. And therefore, non-agri segment is going to be the growth segment.
So for Finolex, is there a ballpark kind of internal target? How much would you like to grow? And what can you do to make that happen?
We expect the industry to grow anywhere between 10 and 15%. And we expect us to do that as well.
Between 10 and 15%?
That's right.
Growth in volumes, essentially.
In volumes. It's the revenue in rupees crores is less predictable because that depends upon the PVC prices.
Give and take everything, sir. What about the margin outlook? That's come under quite a bit of pressure in the last few years. Given that pricing is stabilizing now, volumes could improve. Your mix as well, you've got it pretty much under control. What should the margin band look like in the next year?
See, as the mix has improved for us, improved in the sense as non-agri has contributed more to our overall performance, we have seen the margins improve. Right now, it is almost at a 10.5 rupees per kg mark. And as the non-agri contribution increases, the margins will increase.
Cash on the books is in excess of 1,500 crore rupees, Mr. Venkatraman?
That's right. That is
and
right.
How are you how are you planning to utilize that? When is the board going to deliberate on perhaps a buyback or any kind of a special dividend? Because you keep generating cash and your annual capex is, I think, only about 150 crore rupees. So what's the plan on utilizing the cash?
We will be soon looking at expansion in the sense that in the next couple of years, looking at the growth, we will need additional capacity to be coming in. Just last year, we added 25% to our fitting capacity. In the coming years, we will need additional capacity in the pipes as well. So that is something which will take up a portion of the cash reserves. But yes, there will be more cash than what we need. And the board will decide whether to when to give it back to the shareholders.
But a few years down the line, right? Because you said capacity utilization is only about 65%.
65, and we need to plan for additional capacity, given that we are expecting the industry to grow anywhere between 10 and 15%.
All right, we'll leave it there, sir. Thank you very much for joining us, and appreciate your time here on CNBC-TV18.
Thank you.
Thanks indeed for being here. Well, the markets, I think, come off a little bit, not much. About from 100 up, we're up 76, so just under. So 21,988 is where we find ourselves at. More sort of commentary on stocks, etc. in just a bit, but I think we have our next management waiting back to you.
We do. It's Zen Technology. That's the next corporate. Q3 was a strong quarter for the company. The revenues went up 90%. EBITDA surged by 150%, and that led to an increase in the company's margins to 42.7%. Ashok Atluri, the chairman and managing director at the company, is now with us on the show. Thank you very much for joining in. Strong Q3 this year has been good for you. 9-month FY24 revenue growth is 142%. What can you end FY24 with? And can you give us an early indication of FY25 in terms of a top line? In the past, you had spoken of a revenue growth of 900 crore plus for FY25.
Yeah, so this year we had projected a target of 450 crores, and now I think we will achieve the target of 450 crores. And next year, based on the order book position, we have said it's going to be 900 crores. And we think that we still stick to that target, and we think that we will be able to achieve 900 crores.
Okay, all right. Hi, Mr. Atluri. I recall a couple of quarters ago when I was asking you whether you're going to get close to that 1,000 crore mark, you said you're not sure, but maybe it's a possibility. So now in FY25, it's going to be very, very close to that 1,000 crores. And FY26, I'm assuming, obviously, you get past that, going by the order book and going by the, the prospects for the business. But let's keep that aside. For the time being, we have these two numbers. My question to you is, what about the mix? Exports are expected to contribute more. So could you tell us how much will they contribute to both these two numbers, 900 as well as 450 crores? And is exports a better margin business?
I think, the first question is, I think it's going to be in the ratio of, 70-30 or 65-35. The exports will be on the lower percentage. And the margins are better in exports usually, because, what our way of approaching any customer is, we want to give them at the most competitive price in the world. And typically our pricing is a little dependent on what kind of competition do we have. So, yes, but because of foreign manufacturers who compete with us, foreign vendors, their prices are much, much higher. And so we have an advantage there. And of course, because of the extra work that we need to do for an export, including installation, remote maintenance, etc., we have a higher margin there.
Got it. That clears it out. Earlier the story was more about a simulator, and now suddenly the anti-drone picture as well has picked up pace. What is the, how do you see both these two contributing going ahead? And is there a margin difference between the two? If yes, what is it?
So the margin is a little lower in the anti-drone segment and higher in the simulator. And the percentage split of the order book currently is, about 56, 57 to simulator, and about 43% to anti-drone systems.
Right. Mr. Atluri, sorry, you said 75% is?
65.
Sorry, 65. What's the mix, sir?
65 to 70% is exports. That is exports, and around 30% is, sorry, the domestic market is 70%. 30% is exports, and 56 and 57 and 53 is simulator and anti-drone system split.
Right. Okay. So just 2 points. One, can you tell us the kind of work that that's coming your way now? Orders that you're coming your way. What's the quarterly run rate, or is it very lumpy and kind of tough to predict? So maybe annual stock taking would be better in terms of order inflow. And especially on anti-drones. A couple of years back, I remember when drones as a technology is not really spread wide and far, there was talk of trying to control the spread of drones and not sort of, because as a technology, it could be pretty disruptive. I think there was an initiative in the US, etc. as well. We've come a long way from there. Is drones as a technology, and of course, then when you come in anti-drones, is it really taken off, and we should not look back at those kind of things, or is there a chance that in the future we may see some controls, etc. come through? Because it's a global thing. How do you look at it?
So I think the drone market, the regulation will be there, very strong regulation. But very frankly, the bad actors will anyway get access to this, and they will act on us. So we have to do a balance between stifling the innovation that's happening in the drone segment versus regulating it. I think Indian government has done a fantastic job. They're very, very liberal as of now, and I think that should continue. And with enough checks in place to ensure that don't become threats. But again, these are all evolving. The drone is evolving. Now most of the anti-drone systems, you see, they are made for 2.4 gigahertz commercially available. But the fact is that your threats are not only for commercial bands, but they may be in other bands also. Because I don't give a damn about the regulation. So the counter drone things are also evolving very fast. Then today has a solution that goes across not only commercial drone but all the other bands which the military wants. This kind of the cat and mouse game will keep going, where the bad actors will try to keep evolving the drones, and we have to keep evolving the counter drone technology.
I'm assuming that the bad actors, because you can do a lot of damage with commercial drones, and that's the risk, and that's where you in a way, so far, that's where the anti-drone technology comes in as well, right? But you're saying the military drones, etc.,
the commercial
which are more
drones
regulated.
in the sense that I'm referring. I'm referring to the bands in which they have to operate. There's a commercial band, the 2.5 gigahertz or whatever. That's the band they're allowed to operate by the regulators. But if I'm a bad actor, I don't give a damn about you got the point. I will do any band that I want. So that is where the threat comes from, and the counter threats have to be, counter technologies have to take care of those threats into account.
Right. You said you do expect strong regulations to come in. Is something imminent? Are discussions underway? Should we expect something soon?
No, there are no strong regulation. What I'm saying is the government is going for liberalization of all the regulation to ensure that the innovation is not stifled. But I think they are going to evolve to say that, how do they prevent the bad actor from actually hitting it? Okay. I am not privy to any new regulations being framed in this direction.
Okay. All right. Mr. Atluri, very quickly before we let you go, you're looking at some inorganic opportunities as well. Anything on the anvil? And if you could give us a rough ticket size?
Yeah, so, what we are thinking is that there are about, including international companies that we are looking at, and they are, in different stages. And we have said that we would like to get only into, technologies that are related to what we are doing, not completely unrelated kind of thing, which will build some kind of a synergy or, give us entry into the, adjacent markets. So yes, the ticket size could definitely vary. It could be in a very low figure to all the way up to a few hundreds of crores. So we are looking at this point in time, but our criteria has been this, that it should be a company that does R&D and IP owned, and we want to at least take a majority stake. And in fact, now we are looking at 100% acquisition, and maybe with a swap, or with a cash payment, or maybe little shares. So,
Any
but
candidates
again,
which
if
meet...
they don't own the IP, we don't want to touch them. Yeah.
Sure. Any candidates which meet all your criteria, your requirements? Is there anything on the table right now? Can you close an acquisition in the next 6 months?
So it's a little premature, I think, little premature to talk about them. So, we'll definitely let you know as soon as we are, as soon as we come to any conclusion. But I think they are at different stages, and we think that this will be very well received by the shareholders as and when we announce them.
Got it. All right. There's a new listing as well, Entero Healthcare, opening a little bit down, closer around 2%. We'll chat with the management in the next 30 minutes or so. But that's the listing up for you on the screen.
All right. No, I just, sorry, the listing we're just going through. I just one last question, maybe if we can slip into for Mr. Altouri. Mr. Altouri, these the conflicts we have in the Middle East and the Ukraine and Russia, is that a large driver of export sales for you right now?
What has happened was, first Armenia and Azerbaijan happened, where they used drones extensively, Azerbaijan, to win over Armenia, at least get an edge. And then the Ukraine war happened, where extensively they kept using the thing. And, even in Ukraine war, you see that, Ukraine has been gifted the world's most advanced equipment, but they still don't have an edge. And somebody said, if with that equipment, you can win a third world war, but they are not able, because they're not trained. They have the best equipment. They are not trained. In fact, the fact that there is equipment they are being attacked, and they're not using the equipment. So the training and the simulation part has become very important. And even in the Middle East conflict, we see that, people with hand gliders actually take over a country that is said, we are Iron Dome protected, most secure nation in the world. For 6 hours, they completely control the sub part of the country. So you see that, the training has become very, very important all over the world. They have started saying it is not the equipment, but training and simulation that is important. And the second thing they are worried about it, that they are not now the way sword fighting evolved to gun fighting, the same tectonic shift has happened in terms of drones being used. And there is hardly any counter drone technology available. Sure. And so these are the 2 points. Training and counter drone technology are the biggest point. And fortunately, Zen is exactly at the sweet spot that we are offering the solution. You're absolutely right. At this point, there is a high awareness and high request that we are getting to equip the different nations, our Indian-friendly nations, with adequate training and counter-drone technology.
Got it. Mr. Altouri, we'll leave it there. I like the poster behind you. Think training is hard, try losing. Appreciate you joining in, and it's a great conversation as always. Thank you for joining us. Well, Prakash Gaba is with us with a quick check on how the market is doing. We're above 22,000 levels. Prakash, new highs, and what would you do in terms of trades?
Well, yes, good morning to you. Once again, Nifty looks okay, but it's a good trade only if it crosses today's high. Once that happens, we'll have a breakout. So far, because it's open to the gap up, so it could stay sideways. So far, it looks good. Bank Nifty is seeing some bounce from today's low. If today's low holds, there's a good trade here on Bank Nifty, and we can see an up move from here. I like 2 stocks here. One is Info Edge. Yes, it looks good. 5274, it's trading. One could have a stop below 5220. Just around 50 rupees. On the upside, the target could be 5,400. So Info Edge looks good, and perhaps we could see an up move there. Second stock that I like is MCX. I think given a breakout after a good base formation, trading at 3581, I would have a stop below 3525. Possibly we'll see an up move to around 3,750. So MCX also looks good to me.
Prakash, thank you very much for that. Auto is the top index gainer right now. The Nifty Auto Index up 2%. And the top 3 Nifty gainers are auto names. Bajaj Auto, Tata Motors, Maruti, all rallying 2.5 to 3%. Get into a break. On the other side, Manisha will join in and put the focus on commodities. Welcome back. Let's turn our attention now to commodities. Manisha is now joining in. Manisha.
Well, thank you so much for that. I'll talk about the sugar prices right now, because when you look at the last 1 week, we've seen the prices decline in the global markets, down by nearly 5%. But for the year until now, we still are nearly 10% on the higher side. And this is the quantum that the sugar prices put in the previous year, in 2023, when we closed the year 10% on the higher side. We've seen those kind of gains already happen in the first couple of months of this year. Well, this is how the sugar price trajectory really has been. We started the year with 20.9 cents a pound. We did see a gain up to 24.46. But it has been profit-taking since then, and currently we're trading at 22.9. So at these current levels as well, we are at a multi-week highs into the markets. We are trading at around 10% higher from where we opened into this year, clearly off the kind of highs that we saw into the year. The decline has come in because of the couple of factors here. One, when you look at the Brazil sugar output, that is higher by 11% as compared to previous year. But remember, those dynamics can change at any point in time. The reason you have higher sugar production from Brazil is because the crude oil prices are stable around that $80 a barrel mark. We've seen the prices trade within that 76 to 84 on the higher side. But as I said, that could change if the crude prices stay above 85 for a longer time. If we are headed towards that 90, then you will see lower sugar production and higher ethanol production coming in from Brazil. The other is the global consumption, which also is expected to rise on an year-on-year basis in this year. And much of that demand growth will come in from Indian markets, where the expectation is that you could be looking at a record 28.5 or even higher a million tons in sense of Indian demand for this year as well. So that would be supportive for sugar. Is the reason that you have India absolutely absent from sugar export as a market. You also have seen ethanol production or divergence being cut as well, because India needs more sugar into the country right now, and especially ahead of the election year as well. That's one thing that the street will watch out for. I also want to put numbers in sense of global deficit or surplus. So in the previous season, it was a 5 lakh tons of a surplus. But this year, it's an anticipated 7 lakh tons of a deficit because of lower production in Thailand and India being absent from the market. And Brazil is going to be quite a tricky situation to be in, depending on where the crude prices go.
Manisha, thanks very much for that. So that's sugar in focus today. Well, Glenmark Pharma is the next one we're going to shine the spotlight on. Vivek has got more details on this one. He's back. Vivek.
Well, that's right. So what actually happened was that in Q3, Glenmark Pharma reported a surprise loss versus analyst expectations of a profit, and the management had alluded to the fact that there was a one-time hit. So in the con call, that happened at 8:30 a.m. today morning, the management gave more details on what exactly was the one-time hit. So the company went ahead and implemented changes as far as its distribution model was concerned and rationalized some channel inventories. So growth in the India business, ex of the one-time impact, was actually 9% on a year-on-year basis. Now, what they have said in terms of Q4, they will be back to their normal sales growth, and in fact they say that they would expect close to 1,000 crores a quarter as far as domestic sales are concerned. Along with that, they expect India to continue growth at the pace of 10 to 12% annually. Now, talking about the EBITDA growth, the company has clearly said that they expect a significant ramp down as far as R&D costs are concerned, to the tune of $45 to $50 million. So they expect that to aid the EBITDA. Also, they're expecting a significant ramp up in royalties, and they expect that that will be a big margin profile driver going ahead. And also, they expect operating leverage benefits to kick on. Along with that, they've given an update as to when exactly they expect the proceeds from the Glenmark Life Sciences deal. Remember, Glenmark sold Glenmark Life Sciences to the Nirma Group. So they're expecting to receive 5,600 crore from this particular stake sale, and they expect to be net cash positive by the end of this year itself. On the back of this positive commentary, stock is among the top F&O gainers today.
Thank you very much for that. The other big loser today is Gujarat Gas, post the Q3 numbers. Sudarshan joins in with the details. Sudarshan.
That's correct. So Gujarat Gas is under pressure after weak commentary in the analyst call. For FY25, the company has given muted volume growth guidance of 8 to 10%. In 9 months till now in FY24, company has done on an average volume of 9.20 MMSCMD. So for FY25, the addition is just in the range of 0.80 to 1 MMSCMD. That too will come from just one segment, that is CNG. Even on the earnings front, it was a miss. Revenue was at rupees 3,929 crore against poll of rupees 4,051 crore. Volumes were at 9.16 MMSCMD versus poll of 9.50 MMSCMD. Brokerages too are negative on the stock. Jefferies has an underperformed call. Target is raised to 470 per share, but still 16% downside from current levels. It says volumes are impacted by further market share loss in Morbi. Volume growth guidance for FY25 is a dampener. CLSA has a sell call. Target is rupees 360 per share, which is nearly 40% downside from current levels. CLSA says says management has guided for 10% volume growth and a unit EBITDA margin of rupees 4.50 to rupees 5.550 per SEM. On the valuations front, it says 30x P multiple is unsustainable and it sees risk of further EPS downgrades.
All right, Sudarshan, thanks very much for that. Stocks down big time, 5%. We'll take a quick commercial break here, but we'll come back and put the focus on the oil and gas space. We'll get chatting with someone who's run an oil marketing company, Mr. M.K. Surana, former chairman and managing director at HPCL. And we'll also have top analysts join in on the space. Prabal Sen is energy analyst at ICICI Securities. So trying to understand what's going on. Big moves in all these oil PSU names. Stay with us. Welcome back. 120 points higher on the Nifty is what we have. Let's talk about the oil and gas space. Upstream, downstream, standalone refiners. Everything has been doing fantastically well. Big rallies. And, the price move is forcing people who've stayed on the sidelines to change their view, participate. Analysts are, double upgrading things from, 500 rupees to 800 plus, like we've seen in the case, I think, of BPCL today, this morning. It's... the price dictates the mood, the sentiment. But fundamentally, what has really changed? That's what we want to understand. And to help us do that, we have Mr. M.K. Surana, former chairman and managing director at HPCL. He's run as big an organization as one can think of. And we also have Prabal Sen, who's a top energy analyst at ICICI Securities. Gentlemen, great to have both of you here. Thank you very much for your time. Mr. Surana, if I can start by asking you, sir, maybe a little tongue-in-cheek, but you know, one of the things which people say about PSUs, the logic to give by PSUs that, you know, they were highly inefficient, they've all become very efficient. As someone who's headed an organization of scale, do you think it's a bit of an exaggeration or you think it's true?
So good morning, Prashant. Let's see the question in two parts. One thing is probably people are used to paint everybody in the same brush. So there were PSUs were inefficient. There were PSUs which were efficient. The same case in the private sector also. But somehow the perception was that the private sectors are more efficient than public sectors. But having been in public sector, having worked for almost 40 years for public sectors, and having seen the public sectors functioning, I don't think that was entirely true. There were a lot of skill set available within PSU. In fact, many of the good private sector companies in the space where PSUs are made by the people who are ex-PSUs only. Even abroad, many of the multinationals are made by the people who are ex-HPCL, BPCL, IOC, ONGC. And therefore, as far as skill set concerned, that was never in doubt. PSU had been one of the best training grounds and the grooming grounds for the talents. One of the questions which used to be there was related to some processes, some procedures which used to hinder the decision-making process.
Yeah.
There is a change to that effect where there is more aggressiveness, there is more realization to the impact which decision create in the market. The people are more oriented to how their share prices move in the market, and market cap had been the performance parameter in the oil PSUs or the PSUs, which were not the case earlier. And the last part is after the listings have happened right from 92, HPCL was one of the first to get listed.
Yeah.
So over a period of time, substantial minority shareholders have come in, and so the demand of the stakeholders have also increased. That's one part of it. Yeah. And the second part is over a period, the PSUs have been more adept in accommodating the new processes, new procedures, new technologies, etc., etc. Yeah. And the management also, the newer generation as well as the older generation has become alike to like any other private sector. And I think this is a sum total of that which we are seeing as far as the efficiency is concerned.
Yeah.
But I still believe that people in PSU have been as efficient, as hardworking, as sincere, rather more loyal than in many cases than many of the private sectors. Not to say anything wrong about the private sector, they had their own skill sets.
No, absolutely.
Mr. Surana, I think it is only being perceived now, it is getting demonstrated and it is being received well. I will put it.
No, absolutely. It's a very beautifully put. And my question was not at all about the skill set. I mean, absolutely take your point on, which is about processes, etc. And that point that you made about incentives, right? Much more attuned to share price, market cap. I mean, that is such a powerful shift, mind shift change, which I think has happened. Just one more specific point, Mr. Yeah, that is come through.
Technical orientation otherwise.
Absolutely. Mr. Surana, just one thing specifically. So, you know, it used to be that most refineries here in India could not process, dirty crude, right? Only a few in the private space could process that, like the Jamnagar one, etc. Has that changed across OMCs? And
yes,
so that's also a fundamental change? Yeah.
Yes, to some extent, yes. Because if you remember earlier, most of the PSU refineries did not have the bottom upgradation facilities, but as in between the margin started getting under pressure, the need for deriving the best values from the bottom of the barrel kept on increasing. And a lot of the companies have put in facilities to upgrade their bottoms to more value-added products and the distillate yields. Okay. And that has led to many of the capex which has been put in last 5-10 years. And those are getting fructified now to get much better product yields. Incidentally, it is also coinciding with the good margins on diesel and petrol. And that is so that is what is definitely added to the profitability of the PSUs. Added to that, the energy efficiency, because the fuel and loss factor, which remains one thing. When the energy efficiency comes, it has got twin impact. One is from the decarbonization part or the reducing the carbon footprints. At the same time, the economy of operation as well. And that is also added to the thing.
Got it. Let me get Prabal in. Points taken, Mr. Surana. Prabal, you heard Mr. Surana. To your mind as an analyst, what are the top 2 or 3 reasons why we've seen such a big re-rating and why many believe that there are much more upsides?
So I think I hesitate to follow Mr. Surana, who explained the industry dynamics much more clearly than anybody else. But there are 3 reasons. One is that if you look at both oil and gas prices, the range at which they're operating right now, I think till about $85, $86 of crude until about $12 to $13 of LNG. It's a price band that the Indian consumer or consuming companies can actually work with in a very comfortable manner. As far as upstream is concerned, oil realizations anyways are capped at about $75, which is higher than what they've done in the last 8-9 years. So it doesn't matter much if crude goes to 80 or 85. And as far as OMCs are concerned, marketing margins, when the prices were last actually changed in a meaningful way, if you look at equivalent crude prices then, as long as crude remains below $85, you will continue to make reasonable marketing margins. Mr. Surana mentioned about the impact of the debottlenecking, the bottom upgradation, upgrades that have happened across the OMCs on the GRM capabilities of the OMCs, and the fact that that has coincided with a strong uptake in diesel, petrol, and ATF spreads, which, unlike in the Singapore benchmark, are actually about 65 to 68% of the product yield for Indian refiners. If you put that together, then both on the refining and marketing front, the prospects appear to be much more stable. Specifically for, let's say, a stock like HPCL, where refining capacities are also being expanded and they're also adding significant petrochemical capabilities. I think the earnings mix, visibility, and the scale of operations all actually is slated to, improve over the next 2 to 3 years. So there are tactical reasons which have led to an increase, plus there are structural reasons from a 2 to 3 year perspective that are both actually working in favor. Yes, there will be obviously dips depending on what kind of price cut is taken, whether before or after elections. Frankly, I don't want to get into that kind of prophesizing, because that's meaningless. And, we'll have to look at what the margins are as a residual number. But what I would like to highlight is that even if you build in some sub $10 GRMs and about 3.5 rupees of marketing margins, even on that kind of bear case earnings, the stocks are still trading at a 50-55% discount to what the Nifty PE multiple is at, if you look at a 1 year forward direction, specifically for HPCL. I think that is a very, very important metric, that once the overhang or the perception, which seems to be going away, that there's a reason PSUs deserve to be trading at a 60% discount to everybody else, that seems to be going away. And I think that is one important metric, that's driving at least the PSU oil space over the last 6 months.
And HPCL presumably is your top pick, as you highlighted, I think. Prabal, so even if oil already is at about 83, Brent is at 83. So if it goes higher, say it goes to 90, you're saying there could be corrections, but the PE re-rating story is here to stay in that sense. That the perception that they need to trade at a vast discount, that is gone now. So that comfort is there, support will be there.
Yeah, I wouldn't go so far as to say that has gone, but I would say that, you can build in a reasonable discount for the fact that there is always going to be some regulatory interference. There are always more than just profitability as an objective, and rightly so for some of the oil and gas companies. But, if crude rises to $90, again, one will have to see what kind of mix happens between the GRMs and the marketing margins. See, one way to look at it is that what do you actually make up for every rupee per liter of retail margin loss, for example. HPCL today needs to make about $2.6 or so of incremental GRMs. What they are doing well in terms of expanding of Vizag capacity and then adding Rajasthan is that number will go down to $1.5, $1.6. So therefore, if crude rises and product prices also rise in the markets and GRMs therefore go well, even if you're not making that much money on marketing, your overall earnings may not get hurt. And I think that is a very significant change that is happening. So when we'll have to look at the balance rather than just look at an absolute crude level. Yes, if crude rises, sentimentally always one looks at marketing and says, it would probably create some bearish sentiments. But I think that looks to be changing, from a 2-3 year perspective.
No, got it. Mr. Surana, you're no longer running HPCL, and I'm not sure if you're investing, but if I were to ask you again, maybe an unfair question, what's the best company in this space? From an investor point of view.
That will be incorrect for me to answer. But just 2 points I want to add to what Prabal said. The oil marketing companies or the oil companies always have an intrinsic value, but there used to be a risk perception against the thing in terms of the global dynamics and the government intervention, etc. During last 2-3 years, during the Corona time or during the Russian war or during the Middle East crisis, the way the crude supply portion has been handled and the policy decision has been taken and unequivocal stands have been taken, that is probably given, and during the Corona time, the way the whole thing has been happened as far as supply chain is concerned, the risk perception on the total commodity of oil has changed. That's what I think. And the people are perceiving it to be more resilient industry than what they used to do earlier. That's one point. The second point is that as such, because the market is going up, the value creation opportunities are limiting, and so the some of the things which had the value but were not getting realized are getting realized now. That's the second thing. The third part which you asked, that which is better, it is incorrect for me to answer, but all the three companies have their own plus and minuses and have added strengths, especially depending on the capex which they have put in and the type of facility which the companies have put. And all three are integrating with petrochemicals and expanding the capacity and putting some facility to decarbonize and bottom. So I think there is a value. Depending on what capex and what is the timing of fructification of the capex, the value will get realized. And their HPCL is having an advantage because last 5 years capex which was being put, that is getting fructified now.
Absolutely. There's a great conversation and great points, Mr. Surana. Prabal and Mr. Surana, thank you very much for joining us. This is a short conversation, but I hope we can have you back, Mr. Surana, for a more detailed chat, because this is a theme, I think, which has got legs to run, as both of you would agree. Thank you very much for being here on the program. We'll wrap up on this edition of Bazaar. We'll take your leave. Thanks very much for staying with us. Market is up 130 points, almost at the day's highest point. Chartbusters is coming up next. It'll take all the action forward. Stay with us.